Hello, everybody. It is January 12th, 2023, and it was CPI print day. And it was weird because like 4 people asked me ahead of time, what do I think the CPI print is going to mean? And to every person, I said it'll be a non-event. It's nothing that we don't already know. Why? Because we've been talking about inflation coming down in the second half of 2022 and into 2023 for 6 to 10, maybe even 12 months longer than anybody else has been talking about it. So what did the CPI print really mean? It just confirmed what I've been saying, that inflation was going to come down, that there'd be a 2 handle on inflation by later in 2023, I think around Labor Day, and the Federal Reserve is not going to have to raise rates much anymore. But here's the thing. It's not the interest rates that matter, it's the quantitative tightening. And if Seeking Alpha would let me publish the article with the title, "It's the QT, Stupid," I would publish that. But it is the QT. What do I mean? So this article over at Forest for the Trees with Luke Grumman makes it pretty clear what is going on. In 2022, the Fed's balance sheet was reduced by 2.4%, about $200 billion, as much as it's ever been lowered before, except in one case. As you can see on this chart, every year that the Fed reduced its balance sheet, stock market was negative. 2015, 16, 17, then 18, we had the huge volatility for another negative year. And here's the number to take a look at, 373. So last year was 206 billion in a reduction on the Fed balance sheet. And remember, because the Fed balance sheet is $7 or $8 billion now, whatever it is here, 8.5 billion, there's more that they can reduce. All this money that's on the Fed balance sheet is money that's been pumped into the economy via the bond and banking systems. So when they suck this money out of the economy, it causes an adverse reaction in the asset markets. Now, think this through. We're scheduled for $1 trillion of money being sucked out of the system. What do you think that's going to mean for asset and equity prices? We already know that the Fed is no longer buying mortgage-backed bonds. That has caused mortgage rates to go up more than what the federal funds rate has gone up. So if we are still in an era where certain assets are overvalued for the price of their growth and the general net asset value of the company, property, plants, and equipment, plus cash, minus debt, you start to ask yourself a pretty interesting question. Wouldn't I prefer to be in the growing companies that have cash? And we know that that's QQQ. But the narrative, which has always been wrong, is that it takes longer for tech companies to make money, therefore higher interest rates are bad for them. But what do we know about tech companies? What business model have they moved to? Bueller. What are the tech companies selling now? Starts with sub, ends with subscriptions, right? Subscriptions, software as a service, whatever you want to call it. They have recurring revenues, significant recurring revenues. I have talked to you over about the beauty of subscription-based businesses. It's why I can sell what I do for literally 70 to 90% less than I did 10, 15 years ago. What I used to have to do is go out and chase every single client, sign up clients, and charge them about 1.5% to manage their assets. Otherwise, I could feed myself. You have your inevitable churn because somebody's nephew got in the business. You have people who aren't patient and they bail before the investments that you bought this year for a few years down the road before you get to a few years, because people are emotional and hot money is hot money for a reason. You got to keep on going out and selling the widget. Well, now you're basically paying a subscription for the widget so that you always have the newest, most up-to-date widget and the services that go along with it. That's why the EV companies are going to make a fortune, because as these cars drive themselves more and more, the cars become entertainment centers. There'll be all sorts of things that your cars do for you in the future that you normally would have to go somewhere. And all you're going to have to do is pay to have that service turned on in your car. And that applies to a lot of things out there. Pay the fee, get the service, and the service just keeps getting better. All the businesses that offer technology, when I say all, I literally mean almost all, are offering something that gives them recurring revenues. So not only are you buying the widget because you need the hardware, but you're buying the software or the service via a subscription of some sort. So the idea that the tech stocks are the ones that should be getting beat up right now is ass backwards. The stocks that should be getting beat up and will eventually are the companies that are CapEx dependent. They have to constantly refinance their balance sheets and now are looking at loans in the future that are going to be more expensive than in the past at a time when their widget generating business model isn't making as much money. And a lot of businesses are getting broken, is the point. So the companies that are going to get hit next as the Federal Reserve stays tight are going to be those companies that don't have recurring revenues from services. It's going to be those companies that require things that are difficult to get, that still suffer from inflation, or at least higher pricing today than it was yesterday. And most of those companies, as I've shown you with my screening, reside in the S&P 500. So when you go to Stock Rover, which I should have had pulled up, should have it pulled up for every webinar. When you go to Stock Rover and you do your screening for growth and for net debt and for shareholder yield, you can see that somewhere around 130 or 40 S&P 500 companies are pretty obviously in trouble. And there's another 70 or 80 that could be in trouble. So the S&P 500 is where you should be worried. So if you own somewhere between 130 to 200 of the S&P 500 stocks, either via the S&P 500 or another fund somewhere that's highly correlated to the S&P 500, which you can tell by looking at the beta. If the beta is very close to 1, like 0.98 to 1.02, then you probably have a lot of the top holdings of the S&P 500. And somewhere between 20 and 40% of those are crap, even though people stay invested in them. Now, I will be very careful how you take this next comment, because I've gotten some blowback about it. I talk about the old men panicking, and really it's that they feel shame when their investments go down because they're the ones who are supposed to provide for everybody. The group of retired men now believe that they're supposed to be the providers. And when their investment portfolio goes down and they think that affects the family, they panic sell. They do. Multiple studies have shown this. I've experienced it as an advisor. They just can't hold on for the requisite number of years for the investments to go up again. They inevitably sell near the bottoms of cycles, and they perpetuate the bottoms of those cycles. The indexers are the other group, and they're weird because they only look at their statement every quarter. You know, they rarely look at their statements, but usually it's their 401k statement. Get it every quarter, or they look every quarter. And if it goes down a few quarters in a row, they go, well, I should reduce what I'm putting in and I should sell what I have, which is, again, ass backwards. When the stock market's going down and you have a good income, you should add more because you're buying at lower prices. Use the grocery store example again. Hey, look, I love bananas. Bananas $1 a pound or whatever it is they go for. Okay, I'm going to buy the bananas because I like the bananas. But then the price of bananas goes down to 50 cents a pound. There's a sale. And you say, oh my God, these bananas are cheaper. I'm not buying those because there must be something wrong. So you miss the sale. And then you go back and buy your bananas at $1.20 because, inflation. The price of a stock in the short term does not reflect the value of the stock, of the company. It reflects the short-term idiosyncrasies, emotions, and bipolar disconnections of the madness of crowds. So when you ask questions or think about things based on the narratives of the madness of crowds, you're going to screw up. You won't buy what you're supposed to buy when you're supposed to buy it, and you will mess around in the middle of the market, which you're less than 50% to beat, unless you are a spectacular technical trader. 4 out of 5 or 9 out of 10 of you are not. So don't mess around with the middle of the market. I tell you this over and over again. But you say, but I might miss it. You have a fear of missing out, FOMO. Look at the chart I have up. When the Federal Reserve is shrinking its balance sheet, the stock market goes down. And so does the value of real estate. I've told you what the bad parts of the market are. Slow growth companies and companies that are reliant on financing. Now, that's a little actually different than CapEx. CapEx for a lot of small companies is something in the short term is high and in the long term is low, right? They have to build out. Versus a company like, say, Procter & Gamble, which has no growth, hasn't for a long time, and has to constantly finance to build their widgets. Forever, they'll always have to do it. It's not like they built the great big thing and now the great big thing produces cheaply. They have to build the great big thing, take care of it, and put a shit ton, special unit of economic measurement, of money into making their widgets over and over and over again. In their case, it's toilet paper and I think cereal. And we see what happened when everybody wanted extra toilet paper. So I have been talking about this stuff a very long time. December of 2021, over a year ago, before the quantitative tightening started in March. So 4 months ahead of time, I told you the Fed is going to reload its bazooka. And that's what they've done. If you go back to this article, which I actually had part of it highlighted and it disappeared, so we'll just stay up here, you'll see that pretty much everything I've said is about right. My time frames have been a little off. I thought, because I agreed with Jeffrey Gundlach, I thought the Fed should have started backing off a few months ago. And I don't really think that they should have ever gone to the full quantitative tightening that they've gone to. But they did it. So they over-loosened, right? That's what these big numbers tell us. $4.5 trillion added to the balance sheet during COVID. This 90 trillion was the repo market bailout. This was financial crisis. This was, oh my God, we must not have done enough. When they backed off, then they're like, oh, no, we better do it again. You notice it almost has a political angle to it when these tightenings and loosenings occur from the monetary standpoint. So they're tightening right now. I think they'll tighten till around Labor Day. But what happens next year? Presidential election. And I would imagine Chairman Powell has no love lost for Donald Trump if he ends up being the Republican nominee. I don't think he likes anybody on the Republican side right now. Not unless there is a new centrist that emerges. But I suspect once the Federal Reserve gets the correction that they've been talking about wanting for a year now, they've been talking about wanting stock prices and real estate prices to come down for a year. Once they get that, that's the signal that they back off on the quantitative tightening, at least partially. If they don't, they could cause stagflation. Why? Because certain things that are beyond their control. Remember what I told you the 4 most important words were from Chairman Powell's speech 2 weeks ago now? We need more people. He can't fix that. So if you've been paying attention to the news since Powell's speech, what have you heard more about? Immigration. Can't happen fast, but I will tell you this. You are going to see a bipartisan immigration bill. Do you know why? Because about half of the Republicans want it. So the Democrats and at least 10 to 12 Republicans, but I think it'll be closer to 100, are going to agree on an immigration bill. And it will change the status of a lot of people who are technically illegal here, that have been living here a while and working. They just work in the black market, are going to be legalized. And you're going to have Sean Hannity and all the other on right-wing television start yelling, amnesty, amnesty, Biden's doing amnesty. I'm going to tell you this in the most delicate way that I can. Those folks are here. It's impossible to deport them. It would make inflation worse, and it would damage the economy. The better approach is to naturalize them, put them on the 10-year process to becoming citizens. That's about how long it takes. Maybe give them some credit for having been here already. Start with a work visa, green card, citizenship, in that order. I think that's how it works. Pick a time frame. And then you say, we still need another 3.5 million more people. 3.5 million more people. Well, to get 3.5 million more people in the labor force, you're probably going to have to let in 7 to 10 million people. Because they're not coming here single just to work. They're bringing their family. And it's good that those kids come. They grow up American. They grow up in our education system. Get our specific brand of brainwashing. And that might be the only batch we need. Because eventually, demographics and robots are destiny. Did the Fed screw up when it did this? I have argued no. I have argued that they simply pulled forward the baby boomer bailouts. And now they're going to do a half-assed job of quantitative tightening to get rid of maybe $1 trillion of it. So maybe they make 2021 go away, right? maybe that's about how it balances out. In fact, I'd say that's probably going to end up being pretty close. Get the balance sheet down to, somewhere in the middle sevens, trillions of dollars. And then some smart economist is going to say what I'm about to say. And it's already happened. I just listened to the right people. Look, the Fed balance sheet doesn't really matter. Let's treat it like a national mortgage. Put it on a 50-year repayment plan or 100 years, who cares? And charge ourselves nothing interest. There you go. Effectively making it invisible over a very long period of time. And by the way, if we need to add a few trillion because the baby boomer bust ends up being worse than we think, so what? Throw that on a 50 or 100-year repayment plan, because in the end, we're all dead, damn it. John Maynard Keynes, we're all dead. If you're a student of economics and financial history and economic history and investing, you are probably catching a lot of the lines that I use. They're generally quotes from people smarter than us, or at least more experienced, and almost always richer. People who understand how the economy works. So the smart economist is going to say, we're all dead eventually, so just stretch the debt out over forever. And since we're charging ourselves for the money, let's not charge ourselves anything. Kind of like Japan, who has a great standard of living. They have a ton of debt. They just owe it to themselves. And as long as it doesn't get pushed into the banking system, it doesn't create inflation. It's when it does get pushed into the banking system, like here and here and here and here, that eventually it creates inflation. And apparently right about here was the tipping point. But that had to only happen. That only happened because supply chains were messed up from COVID, and Saudi Arabia and Russia screwed with the energy system. Somebody in our chat room, one of the smartest people who's a member here, from what I could tell, and I say that because she's a member here, right? It's kind of a compliment to myself. Anyway, she says, accountants say the same thing about taxes. Defer, 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 die. And then you get the step up in basis, usually, except in IRAs. But then you can do a stretch IRA. And the person who inherits it can defer, 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 right? Just avoid it. Eventually you die. And if we cook the planet and, there ends up only being a couple tribes left, so what? At that point, we'll start trading grain and use shoes, right? Look, the world isn't that hard to figure out. And everybody who comes at it from this whole business cycle, Austrian economics approach is looking at things short term. They don't understand human psychology, and they just don't understand the monetary system that's been created. And I'm not saying that it's right, because I don't have to. I think it is, but I don't have to say that. The fact that people want what they want while they're alive and then they die is the number one dictating thing of everything. You're alive, you want what you want, and then you die. So this idea that we somehow have to pay off this federal balance sheet someday is crap. We don't have to pay it off. All we have to do is stretch it out over a super long period of time and not push the money into the banking system unless we need it to be pushed into the banking system, like to bail us out from once every 100-year financial crisis or a pandemic. Maybe at some point we have to react to an asteroid, or some dumbass actually uses a nuke or a biological weapon and screws up the planetary economy along with it. Or aliens, right? I mean, I'm open to aliens. So there's folks that ask me some questions, especially the newer folks. So I know most of the folks have been around a while already get this. Some of the newer folks that are coming on, you really need to unlearn a lot of things, because the narratives are usually just a stampede of stupidity meant to get somebody else to be dumber than me. I just bought this thing for probably too much. Would you please be dumb enough to buy it from me for more? Thank you. Unlearn this idea that you belong in the middle of the market unless you are a spectacular technical trader. I mean, there are places in the middle of the market where you can make money on the jitterbugging. Shooter does it. He's wonderful. Obscenely better at it than Jim Cramer, and even most of the people that are famouser than him. More famouser? That's a very Wisconsin thing, famouser. Or maybe it's not me, I just screwed up, I don't know. Most of you should not be trading in the middle of the market. And if you were honest with yourself about your actual technical trading skills and knowledge of trading systems, you would back off on doing it. If you understood that the supercomputers and the big money are manipulating things and front running you and planting stuff on Reddit and in the Twitterverse and stock Twitterverse and the Fin Twitterverse, whatever the hell that's called or is, once you understand that it's people running back and forth being driven by sheepdogs that are owned by somebody else that you don't see, you start to think, maybe I should just wait for the wipeouts and buy the wipeouts. Maybe I should just be a bottom fisher and then hold on for years. That Charlie Munger guy has been one of the richest people in the world for several decades now. And I think his most important quote he has is this: the stock market is a mechanism for transferring wealth from the impatient to the patient. Somebody today asked me if I thought the stock market would still get down to around 3,000. The S&P 500 still get down to around 3,000. And he pointed out that I've been saying that for over a year. Well, what I actually said, and I think my highlighting might still be up on this one, and it's not. I don't know why my highlighting disappeared. But anyway, if you take a look at it, the last couple of forecasts, I said that the S&P 500 in 2022 would get down to between the low 3,000s, around 3,000, and the middle 3,000s. And it was in the middle 4,000s when I said it. So the top end of my range has been hit twice. I basically said the same thing about this year. I think we get down to around 3,000, but we probably end the year closer to 4,000 because eventually the Fed will back off. And maybe I'm off a little. Maybe we don't get to close to 4,000 until next year, going into the presidential election. Doesn't matter. If you're not trying to trade the middle of the market and you're just trying to buy good spots, right? Great companies, future great companies at super cheap prices, what does a year matter? Really, what does 1 or 2 years matter? It doesn't matter. Now, a lot of people's calendars have been screwed up because of COVID. A lot of people need to add a year or two to their expectations. That's life. We didn't know the pandemic was coming. We just thought that 2020 was going to be a correction year because everything was so overvalued. And we knew that quantitative easing had to slow down after the repo bailout. We knew those things. And then COVID hit. And we were early on that. I told you a month or two ahead of time. I mean, the minute I saw COVID was happening, I posted it on Twitter. I pinned it to my page. And I said, this is the most important story out there. And within a couple of weeks, I was saying sell almost everything. And then after the market bottomed, I said start buying the gold stocks and gold. Then a couple of weeks later, I had that big list of stocks to buy, which you can see on Tip Ranks if you're not a member, or you can go to the quarterly article. So we were 2 weeks off the bottom when we started to buy. And we really didn't even get in a lot until later in 2020, after that September correction. I do these webinars and I write the articles to prepare you for what's coming, not for dealing with the middle of the market right this second. I want you to think about this stuff so you have a game plan going into it. What if we get a rally before a correction? It's a great opportunity to cut your things that are correlated to the S&P 500, to get rid of companies with no growth that require a lot of money to operate on an ongoing basis that requires financing. Think about your companies that way. Not, oh my God, it went up a little bit. It just went up 10% or went down 10%. It's not the right way to think about investing. And all I'm really doing is repeating a lot of stuff a lot of good investors have said about how they did things. I'd like you all to name a billionaire day trader. Can you do it? I can't, and I think I would know. Now name 10 billionaire investors. It's pretty easy, right? Buffett, Munger, Lynch. You go right down the list. The best trader in history might be Paul Tudor Jones. Made a ton of money on the 1987 Black Monday crash because he said it was going to happen. Yeah. Somebody says the crypto billionaires, none of them were day traders. They invested in imaginary money. People believed that the imaginary money was real money. And so they sold the imaginary money for real money. And then everything crashed. And we're actually going to talk about Bitcoin today because it's important. I have told you that Bitcoin and just a handful of others, including Ethereum, would be the survivors. And I told you why they would be the survivors. And it's all playing out. I can't help that I'm not always in the right year. I can see what's coming down the road. We've been talking about this for years. CES 2020, all the things I told you about then are happening now. We're about to get into that. At some point, this matters again. I don't know if we get a rally first or not. Right now, there's heavy bets on $1 to go down, which means that it probably won't. The VIX is very low, which means that it'll probably go higher, which means that the S&P 500 probably goes lower. Now, how close do these charts get before they reverse? Hard to know. If you take a look at the VIX, what you see, and this is where we made our huge trade, right? This is where we made 600%, because at the end of 2017 and January of 2018, I said buy VIX. It's the whole sell vol, right? This was the sell vol. Everybody was selling volatility options, making money as they expired, selling the volatility calls. And I said right here, right there. I mean, this is maybe the best trade of my career. Actually, it certainly is. We bought volatility right here. That was a doozy. Now, in hindsight, and we bought a little volatility, we just didn't buy enough. In hindsight, when I said that COVID was the most important story in the world, we should have bought volatility then too, because boy, oh boy. And even if we would have sold here, which is probably what I would have done, because it's my MO, sell early, buy early, sell early, still would have been a better trade than this one. So now we have volatility coming down again. And let's take a look at where this line is. Right now, this is where we are. How does that compare? Where do you think that orange line should be? Remember economics class? If you're not sure exactly where the dot should be or where the line should be, make the dot of the line thicker or bigger. I'd say a VIX of around 15, right? Because here it acted as resistance and here it acts as support. And here was the jitterbug dance on both sides. It is pretty classic. Resistance becomes support. A VIX around 15 or 16, I think, is probably pretty buyable. And I will actually put that trade at both websites if it happens. The S&P 500 might get a rally, 420-ish. I think would probably be top side, right? Because look right there. Support became resistance. Look at that, right? That's pretty interesting stuff, isn't it? Doesn't mean they can't break out. Maybe the Fed says, hey, we don't want the economy to slow down, so we're going to get rid of quantitative tightening or cut it in half. Out of the blue. Chairman Powell's been known to do stuff like that. So we'll see. I'm going to start using this chart for you. Now, what if we got a VIX all the way down to 10, which has only happened here, right? Almost got there. Then I would say become a trader for a couple weeks, because it'll be a heck of a trade. So what we know is what we know is what we know. We know that there is a correlation between the stock market returns and quantitative easing and quantitative tightening. We know that there are time delays, right? The correlation doesn't always play out in real time. There's a lag sometimes, or sometimes the market gets ahead. So when certain magic formula voodoo scientists tell you there's no correlation between the S&P 500 and real estate prices, what the central banks are doing and what the Federal Reserve in particular is doing, well, all I can say is maybe you should believe your lying eyes, because when QE happened, we got some corrections and a doozy, and the numbers are right there. Ultimately, price is either going to lead or trail what the Fed is doing. But if you smooth it out, correlation is pretty clear, right? Federal Reserve started to shrink the balance sheet, market came down. So if this really comes down more, this will come down more. It's that easy. You don't need to ask me about the CPI print. When the Federal Reserve Chairman and a bunch of the presidents are telling you we need asset prices to come down, don't you think they're going to make it happen? Stop listening to your freaking Twitter buddy. Listen to the people who make the decisions about the freaking world. One of the bad things that could happen is we could have another energy problem. I've said that all along. Or that China could go back to COVID zero. Energy problem would probably come from more war, whether that's Russia or Iran or whoever. Could just be Prince MBS being a jerk. He's shown that propensity. And if there starts to be another energy problem, another energy price spike, I promise you that the dollar will get stronger to fight that. And that'll beat up asset prices. And that would be the potential stagflationary environment. And there's a strategy for that. If we have to, we'll employ it. But if you've been paying attention to the stocks that we own, the small caps primarily, and the emerging markets, which we pretty much bottom ticked, you're seeing that those have been the ones that have outperformed for a few months now. This is what's going to keep energy, except in short periods of time, from being expensive. So the alternative energy is coming online fast. And by about 2026, we'll be in pretty good shape. Because at that point, EV production and use goes up a lot over the next decade from there, because the factories are built, tax incentives are in place, and we'll be well on our way to increasing the amount of electricity that the grid can handle by around 50%, which is what we need to get to, because EVs are going to increase the amount of electricity we use by about 25 to 50%. but a lot of it will be produced at home because people with a garage facing south or a house facing south, right, pitch of the roof, will slap some solar panels up. Just posted about that at our condominium complex. Hey, we need a new garage. Why don't we build it over here, pitch it south, throw solar panels on it, heat our pool, keep all our lights on, and switch all of our machinery to electrical over time as it needs to be replaced, and never have to buy fuel again and not have to buy the energy from the grid. Pretty interesting stuff, right? Those decisions make sense for a lot of people, and a lot of people will become more people over time, and eventually it'll become most people. So over the next decade, we will once again get to a point where energy is cheap, like really cheap. There'll be panic pumping. There'll be more alternative energy, more EVs, probably add to the Fed balance sheet again because, hey, we don't have to really pay it back as long as we don't put the money into the banking system. If we do put the money in the banking system, it's because, hey, demographics, something short term, we got to get it through. One or the other or both. Now, I said I'd talk about Bitcoin, and I will before I go. I wrote that article about Bitcoin just a little while ago. Talked about who should be buying Grayscale Bitcoin Trust. And if you've noticed in the last week or two, since they made their announcement that they're looking at something strategic to do, the discount has started to narrow. When the narrative came out that, hey, some of the things going on can be really good for Bitcoin. So in this article in November, I basically told you that's the spot buy Bitcoin or GBTC if made sense for your risk profile, right? Not everybody makes every trade. So middle of October, well, here, let's use this chart. Go back just 3 months. Stretch this puppy out. Middle of October, I told you. There you go. Here's your chance. Buy Bitcoin or Grayscale Bitcoin Trust. When's that article? November 17th? Look at that. It was under 16,000. Now it's over 18,000. These volume-weighted bars are a big deal. It's where the big money starts to get interested. The future of Bitcoin is simple. There's not a lot you need to know. It is like a golden passport. Super wealthy will want it. It is a way for emerging markets to hedge against the dollar. It's a way for enemies of America to transact in a digital currency. Pick your country that doesn't want to be as tied to the dollar as they are at that particular moment, or they just want to hide something. Because even though we're going to regulate it in the Western world, and it's getting regulated in China, still going to be plenty of ways to transact in a more hidden fashion than using dollars, because you don't have to use a centralized exchange, aka a bank. The most important thing, I think, is the emerging markets, because they get really beat up when the dollar gets strong. So I think the emerging markets are going to use Bitcoin to at least transact between governments and business. So will the people of El Salvador buy their, I'm just going to use pizza because that's the old joke, right? The guy that bought the $100,000 pizza because he bought it with Bitcoin back in like 2010 or something. I don't think the people of El Salvador will transact Bitcoin between them, but they will have a Bitcoin account and they will use it for transferring money between their other bank account or friends overseas or whatever. And that's going to become very popular among billions of people in the emerging markets who don't want to pay a fee to Western Union to move money, right? If you're in a foreign country, right, think about all the money that goes back and forth between the United States and Mexico. It was all going Western Union for a long time. And Western Union took these exorbitant fees, just totally screwing people. But hey, we didn't regulate them because, hey, we were making money on it. So a U.S. company was skimming Mexicans, but because Americans own the stock, we were like, yeah, it's not so bad. So companies like Western Union are in trouble. And they have been, because this is a way to circumvent getting gouged on the transaction. And it's a way for a year or two at a time, especially when the dollar gets extra strong, to not get beat up, to maintain some of your purchasing power. Billions of people have this problem around the world, transferring money and maintaining purchasing power, because their local currency isn't that strong. When the dollar gets really strong, it really hurts them. Bitcoin has a future. It's going to be a six-figure thing at some point. Pretty easy to do back of the napkin math and get there. Now, I don't trade GBTC in client accounts because the regulators don't want me to. So if you want Bitcoin, you can trade GBTC because of that huge discount, right? That huge discount. And some of you, it makes sense to do it. Why am I throwing Bitcoin into this particular presentation? It's timely. not just babbling. I babble all the time, right? But I pick the topics I'm going to babble about. If you believe what I'm saying about the future of Bitcoin, you should be buying the dips somehow. Whether you're buying Bitcoin through Coinbase, which I told you way ahead of time was going to be the survivor because of what they were doing with the regulators and how they were managing their business. They weren't taking leverage. They weren't investing client money into their own coin, their own token. They operated more like a real bank and a real exchange. They weren't creating fake products based on fake money like FTX. They weren't trying to skim everybody like the Winklevoss twins. You should have no sympathy for those guys. They lose $1 billion, so what? They just found a way to skim it out of the system in the first place. Let them lose their money. Who cares? And I understand a lot of people are going to lose money on all these crap coins. See, I didn't say shit coins because I wouldn't have been polite. It's their own fault. They can lose money too. I saw an article on MarketWatch. Somebody said I lost 90% of my money on FTX and FTX stuff. They wanted sympathy. They started a GoFundMe account. Yeah, go fund this. I brought out my inner Italian on that one. But Bitcoin, it's going to be a thing. Ethereum, backbone of digital contracts. And the digital contracts, right, you have to validate them. Multiple people validate the contracts using the ledger. You get paid for that. So if you own 32 Ethereum, you can start making pretty real money on a real basis. And you'll probably not have the technical expertise to do it. So you'll just take your 32 Ethereum and, give them to somebody else to manage for you. And then you get a fee, right? It's like getting paid rent. Litecoin apparently has some utility. Ripple got adopted by Bank of America, so that's a big deal. Chainlink is being used in the SWIFT system. There will be survivors. There will be value there. I don't know how much longer crypto winter lasts, but I would bet not much more than another year. And it could be just a few more months. So I'll try to figure out who the winners are, who the survivors are. There's going to be some value there. At minimum, I think you should buy a little bit of Bitcoin if you don't have it. I've told you this before. Last time I pounded the table on Bitcoin was when? Summer of 2020. So I'm not pounding the table this time quite as much because there's maybe a little bit more uncertainty about how it gets regulated and what impact that will have. However, it's undervalued now versus the population that's going to want it at some point. Because once it's regulated, you get big money. And once you get big money, you get all the FOMO people. So whatever the big money thinks it's worth, which is probably low six figures, you can pretty much buy it to there and you'll recognize the FOMO rally when it starts and hold your breath just a little while. And when you can't hold your breath anymore, sell into the FOMO over a course of a few weeks, maybe months. We'll see. I don't think we're going to get the hysteria that we did last time, but I think the shape of the chart will go up. It just won't be straight up. It'll be a more normal chart that takes time. And you'll have to control your emotions to sell and use the real technical indicators to figure it out. And we'll work on it. That's what Shooter's doing for me. So stock market probably goes lower yet. I think it probably sets a new low. I don't know how close to 3,000 on the SP 500 we get. I'm guessing a little bit below. Then Jay Powell says, I think we're going to cut the quantitative tightening in half with an eye on getting rid of it if financial conditions get tighter. Remember, I showed you that financial conditions chart last week or 2 weeks ago. When it gets too tight, inevitably there's a snapback. Some reflexive action occurs. And we're almost there. I'd say the next 6, 7, 8 months, we'll start to get a real hint of change of direction. But this whole we're slowing down to a quarter point raises doesn't matter. Doesn't matter. We knew that was coming. They told us 4 or 5 months ago it was coming. It's the QT. Keep an eye on the QT. When they really start hinting they're going to back off on QT, get long, really long. Until then, operate within what you really believe is your true risk parameters. What risks are you really willing to take? And just get out of the crappy S&P 500 stocks. And you wait for your small caps to catch up, which looks like they've started to do. I think that those of, they might double bottom, triple bottom, but I don't think there's going to be a lot of new bottoms in the small and even a lot of the mid caps. Your new bottoms are going to be in the large caps and the S&P 500 stocks. All right, let's call it a day, and I will see you shortly.